Monday, the 26th, 2026. It all seems so picture perfect. What up, everybody? Welcome back to THS Live. We are going to cover all the things that happened over the weekend, which actually wasn't a whole lot. Talk about what's coming up this week. Big week in the markets. We'll be responding to what happens, or in this case, does not happen in the FOMC meeting. What up, Chad? I see you out there. Let's see, we got Instagram up and running. Let me check to make sure all the other platforms are feeding. I believe that they are. Yes, they are. So we're connected on all chat forums. Please leave a comment, whatever you guys want to talk about. We will do that today. I also have some new charts to show you guys, which, as you know, this is kind of an ongoing progression of things that we're going to do. We're moving pretty soon here from the static, this is what the market is saying phase, to predictions that we see based off the analytics we've been aggregating. Things that you know have been a project for a while, kind of like a hedge fund-like model. And maybe we can make some money with this thing eventually. Who knows? We'll see how it all plays out. Shout out to my guy Andy over at First Form for hooking us up with the First Form Energy sponsorship. Never a bad thing. And if you like the show and you want to support us, go over to joinfridays.com, use the code HIGHER, and we will hook you up. Let's get right into the market status of today. There it is. We got a risk profile with no clear trend. This is going to be kind of indicative of the overall macro picture. Dow Industrials up slightly, S&P up slightly, NASDAQ up slightly, Russell down a little tiny bit, QQQ up a tiny bit. What that really means for all of you in real simple terms, it's a mixed day. You don't have tech leading the way on a rally. You don't have any growth. You don't have liquidity flooding the markets, and you don't have liquidity draining out of the markets. And the real reason why is because you think the market's kind of at a bit of a standstill until what happens on Wednesday. You got an FOMC meeting coming up, and people are going to be more interested in what happens there and how it sets the tone. Now, if there was a general consensus that the market was going to cut rates, you would have already seen by now, let me adjust the camera a little bit. There we go. You would have already seen by now a progression downward in the treasuries, and mortgage rates would have dropped. Because the consensus is not that we're going to get a rate cut, we're going to see something very different. You're going to see a very flat, standstill-like economy where the market kind of sits back and watches. What up, Yoshi? I see you in that magnificent beard in the chat. How you doing, boy? Saeed, what up? Gold surpasses $5,000. Yeah, that's actually been kind of one of the surprising things. And one of the things we should probably talk about more theoretically on the podcast is you've seen a pretty visible and palpable disconnect to things that we used to think were attached. Inflation, employment, gold, the markets, inflation in and of itself. Typically, gold only spikes like this during recessionary economies where people are looking at what they believe to be a hedge against inflation. But really, the only true hedge against inflation is to continue to invest. So we're seeing a lot of different things happen that are very strange, and the market isn't really acknowledging all of them because everything at all-time highs, the market, real estate, gold, Bitcoin at around near close to all-time highs recently. You get this weird, sense of euphoria in the markets, right? Everything's going great. Nothing can go wrong. And that's usually when things do and will go wrong. So we're going to break into some new chart work today. I want to share with all of you guys because I think it's important and valuable to share. This right here, as we talked about before, is a U.S. market risk profile. And we take a look at these ETFs here, which are proxies for the indices. So we're not actually using the Dow. We're using the DIA, which is an ETF, which trades off the Dow. But the percentage change is different. It does include derivatives and real cash, so it doesn't exclude some of those things. It actually gives you a real, in my mind, a better snapshot at the markets. And the real value in all this is it gives you this information here, mixed day, no clear trend, and it gives you this heat map down below. This little bad boy, this little tiny chevron, pointing to where we're at. This is going to be thematic over the charts that I'm going to share with you in a little bit. We're going to go sector by sector. We're going to cover housing, banks, commercial real estate, mega caps. And we're going to look at how all of those sectors are interplaying within the context of this particular status. So remember that we're in a mixed day with no clear trend as indicated by this piece down here at the very bottom. And as we get into some of the sector work, and then I'll just jump into one real quick right here. Here's the housing and home builder rate sensitivity demand, okay? So what we're going to do with these charts is we're going to look at 8 different sectors of the U.S. economy and look at 5 stocks within each sector. This particular instance, you've got housing and home builders, and this tells you why we're looking at it. We're looking at rate-sensitive demand, right? if we thought that rates were going to come down and there was going to be a rate cut, you probably would see better performance than a generally negative or slightly negative consensus amongst the home builders. You do have NVR, which is also very rate sensitive up here. But these are the 5 home builders we're going to continue to look at as we look at the sector. They are the largest home builders and they have the largest amount of exposure, and they kind of give you an idea of what that space looks like. But we're also going to look at things like banks. So when I pop on over here to banks, now you've got some of the top banks in the country. And the reason why we're looking at banks and financials is we're going to look at the overall credit conditions in the market right now. So we're not seeing any credit crisis. Again, great financial crisis. Synthetic mortgage-backed securities was largely considered to be a credit crisis type scenario. That is not what we're seeing in this market. As a matter of fact, all the banks, even with no looming rate cut, appear to be up. And if you've been watching the lives or listening to the podcast, you know that Saeed and I are big fans of the banking sector right now. We think we're going to see net interest margin pick back up and continue to derive. And the reason why is you've got loans, right, and deposits, right? And in this particular environment, the spread on these two is getting bigger. As the Fed cuts its interest rates, your deposit rates go down. And as the treasuries rise like they have been, your loan rates go up, which means that banks have more profit. So you're going to see, as long as there is not a credit crunch or deteriorating credit conditions in this space, you're going to see an overall healthy trend in the banking sector. And this chart is indicative, again, looking at what we think are the 5 most notable banks in this space: JP Morgan, Bank of America, Wells Fargo, Goldman Sachs, and of course, Citigroup. So we're going to go over to the next sector real quick, and that is commercial real estate and REITs, real estate investment trust. Most people aren't as familiar with these companies as they are with the banks and some of the housing, just because we interact and interface with those most. I think a lot of people are probably really know about Simon Properties because they own all the malls. But yeah, you're seeing kind of a mixed day here. I think this is where the market feels most of the credit exposure is currently. Is in this particular space of commercial real estate. They felt that way for a long period of time. Obviously, we don't have people fully back in the work environment. So certainly this is where people are starting to feel like a little bit of tension. And let's explain that really basic, right? Number one, if you're in a commercial real estate, you can think of it as multifamily housing. I think that sector is going to be okay. You know, I'm a big advocate of it, but personal preference and bias 100%. Now, you do have the office space, which is going to have continues to have a dynamic and changing landscape. You have malls, which are kind of struggling. And one of the things we're going to switch to here is we're going to look a little bit about is consumer spending and some industrials and energy and some other, I call it defensive stocks, that are going to show you how consumer spending may or may not be pivoting. But again, mixed day, so you're not seeing a lot of up or down in this particular space. And unless there is any type of refinancing risk that pops up, there's not going to be a whole lot of concern or change here near term. And what I mean by refinancing risk in commercial real estate, you're typically not getting longer duration fixed product. You're definitely not getting 30-year. And the longest you typically get is somewhere between 10 and 15 years. And that's very, very, very rare. 15 being a lot more rare than 10. But almost all of these are 3, 5, 7-year product, adjustable rate mortgages, right? They're fixed for those period of times and then they go adjustable after that. And generally speaking, when they go adjustable, they refinance again, hence this mountain of refinance risk. And if these properties are all valued based on their income approach to value, how much money they can generate to an investor, because nobody who buys them actually uses them. It's very rare they're owner user, although that's a whole different sub-market and something we could talk about. These are all investors who invest in these properties and derive cash flow and equity upside. If the cash flow has gone down, the equity has gone down, that means it's very difficult to refinance these things at the current debt levels they hold. So they're often cash-in transactions. Hence the term refinance risk and why this particular sector has more of that than anything else, at least right now anyway. Next, we go over to the mega cap stocks. This is your really a subset of your Mag 7. I call this chart market leadership. And the reason why is these are the people that you hear about every single day that are really drawing things forward. And it's also part of the reason we built in a tech-led sector down here for the market status, where you've seen the Mag 7 kind of pull everybody into a growth and broad rally type of economy, because these guys are outperforming the S&P 500 by a large majority. So here's what we're taking a look at. Let me clear that off. Perfect. So NVIDIA being the only one down, it's only down a tiny bit. So you do have a pretty healthy tech space currently. So market leadership is continuing to grow. Apple's the strange outlier here. I have no meaningful reason to explain why Apple is up 2.96% today. I have completely no excuse for that. And it goes to show you that these guys are going to continue to grow as technology gets more and more absorbed by us. AI is no different here. That's why you're seeing that rhetoric also continue to permeate, also to justify the CapEx spend. Let's go over to consumer. I think this one's very telling. This is your consumer spending and stress, consumer stress. This is going to give you an overall picture of consumer health. Are they spending at Walmart, Target, Costco, Home Depot, and Dollar General? These are all pretty obvious and likely scenarios of where people go to spend their money. I think as you start to see strain in the home market, you start to see a little bit more pressure on things like Home Depot. As people get economically tight, you'll see some of the spending shift from here to places like this, more the discount people. But certainly they're all impacted in a meaningful way. This is an interesting kind of note here, and I don't know if this is because their incoming CEO made a comment about some of the things that are happening from a political and human rights perspective, all of which was valid and all of which was important and real. That's a different show. But and then this actually peaking up a little bit, 2.5%, is something I haven't really looked into yet today. But again, this is how we're going to view consumer spending, consumer health. We're going to do it through the lens of looking at companies and how they look in real time. So all of these numbers are intraday compared to the close of the previous day. So in this case, Friday compared to today and the actual price today during today's trading. So we're trying to get a feel, a real tactile feel for how consumers are spending their money in real time and thus how the stocks are trading. You're going to see some events when earnings come out and things like that happen that really try to deviate and change the way this all looks and feels over time. But we'll get into those on a one-by-one basis when we see it. But to give you an example, Dollar General DG, right? Let's go over here. I will pull up Dollar General's one-day chart, and then we will go to the stock chart, take a look at it. There you go. This is Dollar General's intraday trading today. Obviously, we haven't gone through a full day of trading yet, so there we are. This is on East Coast time because I want to be consistent with some of the stuff that you're seeing. And here you have their high and their low for the day, and you can see that it's kind of trading right in the middle. So no real trend spike up, no real trend spike down. Seems pretty stable to me. Meanwhile, we can go over to Apple, which AAPL. I'll hit the intraday chart there. There you go. And there it is. Okay, so now you got Apple, and this is what I meant why I didn't understand it. You got the low and the high today. It is trading at or near session highs as we go through the day. They're up a pretty healthy amount of money, down a little bit from where we saw on the previous chart, but still, again, that was intraday today versus close. This is intraday trading. So again, really, really interesting to see what's going on here. I'm gonna have to look into it and see why this stock is seeming to do pretty well today. It seems kind of like a strange performance to me, but you know, I have been wrong about a lot of things in my past. I'll be wrong about a lot of things in my future. Let's go over to the industrials, one of the last three sectors I want to cover. This is your real economy signals, what's really going on. These are the staples that we all use, and these are the big companies you've all known and loved since you were kids. Caterpillar, Deere, General Electric, Union Pacific, and 3M. This just gives you kind of an idea that the economy is continuing to boom and grow in the real fundamental ways that we look at it. Who's getting paid? The people who are using the heavy machinery and equipment, General Electric, power, and some supplies of products, Union Pacific, railways, 3M, they're in everything. So a good nexus there. You know, if you watch the show and you've been listening to our commentary on AI, that we've been talking a lot about the energy sector. So it made sense that we do this here where we talk about energy and commodities, but we also frame it in the context. This is not only geopolitics, but it's also supply risk. I think that these are going to be the outperformer, not necessarily the petroleum-based ones like Exxon and Chevron, ConocoPhillips, but the actual electric grid power supply, maybe even nuclear, if you will. Those are going to be the ones that really perform well over the course of the next couple of years. This, again, because we saw on the initial chart there being no real trend, you should expect to see some of the things that we're seeing here where there's not a lot of up, not a lot of down. This last chart was kind of a last-minute add. And I did this under the auspices of looking at what do people go into. And everything that we put together for you guys is about where people that are sophisticated are putting their money, using the stock market as a proxy for where the sophisticated people in their companies are putting their money and making investment decisions. We're going to use all of this to forecast where we think the market is going in the future. But for now, the whole point of this entire presentation is really to give us all an idea of where the money is flowing. That's all this is. we're looking at the companies and the stocks to see how they perform, but their performance in sectors gives us more perspective on that. So these are the companies that I thought, okay, this is where people go when they want to preserve their capital in good old school, old fashioned, you know, I guess constantly producing products, constantly producing yield stocks year over year, S&P 500 just crushing it, right? So what do you have? Procter and Gamble, you know them. Coca-Cola, Johnson and Johnson, you know all of these companies. Nexera Energy, Duke Energy, I expect there to be a flood of money here. These guys have been energy companies for a long time. I think the future is very bright for them. Ha ha, pun intended. But I think you're going to see some growth in those sectors here. So I think this is where the money goes. When we start getting down here and people go risk off and liquidation, I think this is where the money goes. I think that's exactly where people are going to start putting their money because they want confidence in the long term, especially if the bond market does deteriorate. And to give you, again, some perspective on where this came from and why, that's why you got a mixed day. That's why you got no clear trend. All of these ETFs as proxies for the indices are really just taking those sectors that we just saw and giving you a bigger, broader, 30,000 foot elevation. And even when you dive down into those sectors like we just did, you wind up seeing that the market does seem to have a mixed day. There isn't a clear trend. You're not going to get housing way up and everybody else way down. Everybody's just kind of placid and waiting. And of course, the natural logical question is, Chris, what are they waiting for? Well, let's get into that. They are waiting for the biggest part of the week. That's going to be the FOMC rate decision here on Wednesday. Okay, and again, for those of you who haven't watched, there's a wide degree of differing opinions on this. And I should point out the black bars are the things that we think might be important to look at: durable goods orders, consumer confidence, GDP growth, core price index, ISM manufacturing, and JOLTS, which is the jobs report the Fed most closely, I guess, looks at and focuses on. But again, all eyes are on the FOMC rate decision there. And let's have that intimate, sexy talk time, me and you, together, okay? And to do that, I'm going to do what I normally do during sexy talk time. We're going to go into the chat a little bit and see if anybody's got any comments or thoughts. Saeed is the only one commenting on LinkedIn. Was it YouTube? YouTube, yeah. Jamie D and co gave Apple price target boost in the next 12 months. Okay, so that explains that. So let's put that up here. So according to my guy Saeed doing the background work, I appreciate you, brother. The reason why we saw Apple up was because Jamie Dimon and co, vis-a-vis JP Morgan Chase, said they expect them to have better targets for production of iPhones. So in the next 12 months, they expect them to outperform. And that goes to show you some interesting things. If a major player like JP Morgan Chase, and Said, whether you know this or not, your segue game is on target because this is exactly where I was going. A major player who covers a stock, an analyst for a bank, in this case, JP Morgan's analyst covers Apple, and they say, hey, we expect them to outperform. That can meaningfully move the markets as it relates to their price. And I think that's important because people don't understand how much this analyst narrative, people who specialize in covering these people, can really change the outcome for how some of these people look. So let's go over to the stock chart real quick. There you go. This is Apple again, up today, near session highs, because people go, okay, JP Morgan Chase analyst who covers this, who's a smart person, says, I think they're going to outperform in the next 12 months. They go, okay, well, they're going to outperform. That means they're going to make more money. They're going to beat expectations. Their stock's going to rise. They're going to sell more units. They're going to have more profits. I'm going to buy them now because I expect them to go up. Right? Very logical reason. And this is why you see some of these moves like this in the market. Sometimes it's as simple as an analyst saying, I expect them to do better. It's also why we've always recommended that you listen to earnings calls if you can, or if you're interested in the stock, because earnings calls can do stuff like this. The CEO, the CFO, maybe somebody else, part of the organization, will come on the call and they'll talk about where they see things going. And as a result of that, the analysts who cover the stock will ask questions. Those questions then get some type of written output that the analysts will provide to the market, given their expectations, whether they're going to beat or not beat expectations, or they're going to meet expectations, whatever it might be. Think of it as like a report card from an analyst every single quarter. In this particular instance, this is what we saw here. And I think this is important because the segue that I was referencing earlier as it relates to Saeed is that JP Morgan has also made a really interesting prediction as it relates to something else. So right now, I think the market consensus has been two rate cuts in this year, 2026, from the FOMC, just two. Now, again, this is all hyper dependent on the Lisa Cook situation. And for those of you who want a gentle reminder, a slight gentle tingle of refreshing your recollection. If the Supreme Court says that our president can remove her for the mortgage fraud accusations that he has made, and again, I'm not sure the status of whether those are actually filed charges or, criminal, whatever there, but neither here nor there. If he can get rid of her because of that, then he will have a 4-3 vote at the FOMC. He'll have Myron and possibly 3 others to name as FOMC heads, heads of banks, central banks that will vote as part of the FOMC. So then he would be able to have a voting majority who would see things his way, presumptively that rates should go down. Okay. Now, again, this will take time. It's not going to happen overnight, even if Lisa Cook is somebody he can get rid of. If he can't get rid of Lisa Cook, at least not for that reason, and he can't force Jerome Powell out, that means he'll have 3 people voting his way versus the 4 that seem to have a legacy ideology as to where rates should and could be. So I think that's a big swing that could change the outcome of the narrative. And why this is so important to JP Morgan Chase. JP Morgan Chase's prediction is actually different than everybody else. They broke from consensus. In 2026, they say 0. No rate cuts or hikes. In 2027, they see rate increases. So they're the first person that does this. And if you ever watch the show, we're going to do this on Wednesday. We're going to do this in real time. We're going to do this live. But if you ever watched us on the show where we cover this, David Kelly from JP Morgan Chase is one of my favorite. He's very stoic. There's not a lot of energy and enthusiasm out of him, but he's really, really articulate, super sharp dude. And he's a JP Morgan Chase guy. He's going to give you his thoughts on this. I would imagine they probably align with this. But yeah, certainly JP Morgan Chase has a narrative there that I think is meaningfully different. And if they can move the markets for Apple, hey, you never know what they might do. Let's get into the chat a little bit here. Yo, what up, Instagram? I see God, there's so many of you out there that have joined, and some of you have dropped. I'm not going to name any names, my wife being one of them. Let's see what else we got here. Let's go over to the other chats, the combined chat. And for those of you who don't know, I have Instagram. I can't, because their algorithm, I can't pull their chat into one platform. But everything else, LinkedIn, TikTok, YouTube, whatever you're in, I can actually pull you into and do something like this on the platform using Site again as an example, because my guy's over here, handing me alley-oops and dunks and stuff on the backside. So let's continue on with the show. So we know we have, again, I'll go through some reminders and then we'll jump back into it. We know we have a mixed day, no clear trend. This does update in real time. So if it does change, we'll come back to it a couple times and you'll see where that change is. But for right now, no meaningful change here. We'll go over to the synthetic volatility index. And here you have a very calm day, which is indicative of there being no clear trend, very calm, no one's selling. It's very normal. So you're kind of in this upper echelon of, call it, no fear in the economy, no meaningful risk. I would compare this to the VIX being below call it 16-ish, if you're familiar with that. But again, realized volatility, intraday stress, gap, all that stuff, everything seems pretty mellow in anticipation of where the rate cuts are going. One of my favorite charts that we put together, as you know, is this one here. Liquidity is still restrictive by the FOMC. You got a lot of things happening. They're selling bonds at the tune of $60 billion a month, driving up the 10-year treasury. And as a result of that, you're seeing mortgage rates continue to have upward elevation and upward pressure in price. We'll see where all that goes, certainly post rate cut meeting. But given what I'm seeing today on a Monday, you normally would see that ahead of things if they expected anything different to happen. So I think it's a foregone conclusion you're going to get a hold. The Fed balance sheet does show a lot of liquidity, but the reverse repo line and treasury accounts, these two are pulling liquidity out for a net liquidity score of 5, not seeing a ton of liquidity being dumped in the market. So you're not necessarily in restrictive policy. You're what we call tense. I think if the FOMC were looking at this, they would say that all of this is really more supportive than tense, but that's just a matter of interpretation. I think this is where the Fed aims to be outside of needing to pump liquidity in or pull it out. I like to do this to give you guys a broader spectrum and see that there are differing degrees of, quote, healthy liquidity in the economy. I think when you're closer to where the chevron is currently here, you're so close to restrictive that it deserves to be called out, hence the reason why we label this tense. And it's also, again, something that we should note, that this is not the same heat map down below as the one that we have for, let's get into this here, status. There we go. So the difference here is that there's a very different regime paradigm and there's a little bit more optionality. There's like I think 7 options in this versus the other one. So I think just to be clear and point that out, there's a difference there that I think is important. So getting back to the liquidity pulse index, I'm a very big fan of this one. Restrictive tells me that there's not enough liquidity in the markets to change anything, but we're not going to the point where we're restricting things out. If the Fed has this non-QE QE continue to grow, and it does meaningfully change things, and you start to see less usage of the Fed repo line, I would expect this to go this way. Banks borrowing overnight. I don't see that happening fundamentally because what's going on in the economy right now is everybody's getting ready for tax season, right? Everybody's reeling from holiday spending. So banks need more liquidity on hand to put more liquidity to work. So I don't see that changing anytime soon. And certainly unless the Fed cuts rates and decides to pump more money into the economy and we're back to boom town again, I don't see how that really happens. But again, stranger things have happened in the economy and we're really in uncharted territory. And let's go to my last chart that I like to share with you guys, one that doesn't change a whole lot, but gives you a good snapshot of the world. This is the Home Affordability Index, and we continue to be strained. Mortgage rate pressure, as you've seen time and time again, is the biggest pressure, causing mortgage payment burden and price to income ratio continuing to be strained. Income momentum is also strained. These last two, for those of you who aren't familiar, these are derived by the median wages as reported to the Fed, St. Louis Federal Reserve. And those pull directly from the data that they use. So yeah, wage growth does need to happen more meaningfully in order to move this needle in a pretty palpable way. So again, supply is still now healthy once again. So that whole narrative, supply and demand, supply is there, kids. The demand isn't. And because of that, I think when you start kind of going back to my classic example of demand without affordability is not demand, we have demand, right? You've got supply, so the demand should be picking that up, but you don't have affordability. So this is why I always say that you can have demand. People want homes. It's not that they don't want homes. They just can't afford homes. So yes, affordability plays in demand, and that's the definition. But I like to say it that way because it highlights that because things are so unaffordable, demand does not exist. Or at least not meaningful demand anyway in this particular instance. And there you have it, kids. That's the market ahead of an FOMC meeting. That's the ahead of a rate cut. And I think it's going to be an interesting week. And we're going to do this live. This will be one of the first times that we're going to do it live with our channel this way. So what I'll be able to do in real time, and again, these charts update in real time. I try to have them update about every 60 seconds or so. We're going to be able to jump into this and use it while the FOMC is doing the press conference. We typically like to start about, call it 30, 40 minutes before the actual press conference. So let's go over here to our calendar once again, and you'll notice that we do have the date and times here. So the actual rate decision is at 11 a.m. PST, so we'll probably start somewhere around 10:15, 10:30 on Wednesday to cover that event. So for those of you who are going to join us, it is fun. I have liked doing it a whole lot, but everybody's idea of fun is very different. Let's get to our usual socials check. That is the key differentiator in my mind between our show and many other shows. Is what we try to do is try to take a snapshot of what's going on socially and bring it into the show, as well as give you guys a more direct opportunity for engagement. I think with a lot of shows, you'll do the call-in stuff, but you get somebody who's sitting in front of a computer screen monitoring and vetting that stuff out, and I'm trying to do it as much as I can in real time. Charlie Balelo, he is kind of one of the guys who says the housing prices do need to come down. Last I checked, 40K of U.S. home purchases were canceled in December, which equates to 16.31% of all homes under contract. That's the highest cancellation percentage on record. And he's been, I think, a pretty vocal person about how he thinks that there needs to be a meaningful change in home prices. And I get that. I completely get that. But this is pretty telling, right? So if you go back here, 2020, this is the pandemic, really, this area here. So I don't know how much you can rely on pandemic era home cancellations, which is what this chart shows as a proxy, but that was at 16.3%. And there was literally a global health scare, crisis, you can call it whatever you want, right? Pandemic. And then here you are in 2025, just 1% higher than that number. But we've seen some fluctuation and some volatility here with cancellation in between, certainly. That's telling, you know? Now, what it tells you, I think it tells you one thing. Homes are unaffordable and people are concerned about the future. Stock market might not be. Everybody's sitting at all-time highs going, okay, my stocks are all-time highs. My 401k is all-time highs. My real estate, if I own it, I'm lucky enough to own it's all-time highs. But people who are buying homes, they don't feel that confident if they're dropping out at the highest cadence they've dropped out at before. And there's been some rate volatility. Obviously, the 10-year Treasury is rising the way they have. That has meaningfully changed that and moved that needle a little bit. So I don't think that anybody knows for sure what it means, which is why you see a lot of people on social channels like this, like Charlie here, talk about these things this way. I think it's... You'll see that they make these statements, like he says here, 40K U.S. home purchases were canceled in December, blah, 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 blah. But he hasn't exactly said what that means. He kind of leaves it to your imagination. Some people call it like, doom porn or whatever it might be, but I don't. I think if you're being intellectually honest with yourself and with people that rely on your content, in which case he has a great following, you really can't tell people what's going to happen in unprecedented territories like we're at right now. Nobody really knows. And I keep telling people, what's the big correction going to be in home prices? What's going to cause that? What's going to cause this big correction in rate? What's going to cause the market to correct? If we're at an AI bubble, we can all acknowledge that we're at, like, what's going to get there? Yes. This is one of my favorite things, and there's no surprise this comes up on my social feed. And this just in, Nancy Pelosi just made a bunch of changes to her portfolio. Here's every change that was made. And I love the transparency they're forced to make here because everybody knows who and how she trades. Google exercised 50 call options at $150 strike, representing 5,000 shares of Google. Oof. Bought 20 Google call options with a strike price of $150 that expire 1/15/27. Moved 7,704 shares held personally to donor advised fund. Amazon exercised 50 call options at $150 strike price. Apple, Nvidia, these are all your Mag 7. Sold 5,000 shares of PayPal stock, exercised 50 call options at $20 strike price. God, look at all these trades, man. Exercised 50 call options at VST, sold 10,000 shares of Disney, bought 25,000 shares of Alliance Bernstein. And this is what how are you going to do this ethically, man? I understand it's her husband, it's not her, or whatever, but you look at this and you're like, man, that's a lot of trading activity. I don't know, maybe I shouldn't you be like, running the country, like focusing on that, and like, shouldn't it just, it's got bad flavor. It tastes a little sour. It just, I don't know. Again, this is obviously heavy coverage. Everybody over here is seemingly covering this. Unemployed Americans are taking longer to find new jobs, and at any point in the past 4 years, muted hiring deepens concerns about the labor market. Financial Times. Yep. I think that's accurate, and I think one of the things that people tend to forget about is that there are multiple elements to hiring which have become very palpable and problematic that are not often discussed. Okay, number one, ghost jobs. A lot of the hiring posts that you see are a new form of manipulating the narrative, or they're just fraudulent, trying to get your information. Okay? They want to perceive like they're still hiring out in the community doing these things. They want it to be perceived that way because otherwise it's a sign of weakness that they're not doing these things. Number one. Number two, just to get through this process, people are relying on technology, AI, for example, or they're using platforms like LinkedIn. Well, if it's easier to apply for you, it's easier to apply for everybody. And if it's easier to apply for everybody, they need to have better filters. So if you don't meet their criteria, that same AI that'll often tell you something that's wrong is going through resumes with no cognitive, real material reasoning. You don't check the boxes, you're out. So it's frankly like gambling at this point in time. And then, of course, you do have the AI efficiency stuff, which is happening. I think I don't have to check here. I think I found something on this the other day. I'm going to see if I have it in the notes. Let me see if I can pull it up here while we're doing this. Oh, yeah, this is the price change inflation. So this is actually worthwhile to share, too. And I'll put this in the show notes later on. This is the chart of the century updated through December 2025. Let's see if I can make this bigger. I can. Look at that every once in a while. All right. From January 2000 to December 2025, selected U.S. consumer goods and services and wages. This is going to trip you out. If you're watching the show and you don't listen to anything I say, this one is probably the one you want to listen to. All right, look. Overall inflation was right here on this chart, okay? 92.6% from 2000 to 2025. So you're talking 25 years. Granted, that's still a lot, okay? I guarantee you your salary didn't go up 100%. But okay, whatever. All the things, this is crazy. All the things below the line here that didn't keep up with the same pace of inflation. New cars, household furnishings and operations, clothing, cell phones, computer software, toys, and TVs. These are nice to have things. Those aren't those aren't necessities. Okay? Those are nice to have. Those are luxury things you can buy. You can buy a new car, you can get new household furnishing, you can get nicer clothes, you can get an upgraded cell phone, which is probably the least. I mean, in today's day and age, it might be a necessity. Computer software, toys, TVs, obviously all more affordable relative to where inflation has gone. Unfortunately, hospital services, college tuition, college textbooks, childcare, nursery school, medical care services, average hourly wages, housing, and food and beverage necessities have all increased over overall inflation. And I know you said, wait a minute, Chris, you said average hourly inflation. 131% was the average hourly inflation over the average 92.6% of overall inflation. So yeah, you say, okay, you got a, approximately ish a 40, call it percent average inflation increase. But when you start looking at all these necessities that are over that, and again, these numbers are averages, I guarantee you a lot of people are paying hospital services at 281%, double what they used to be, more than double what they used to be, triple. College tuition fees, double. Childcare and nursery, 1.5x what it is. You got to pay those things. Well, those things are going to drag up your average to be in line with tantamount to what you got from a wage inflation perspective. So I think people look at these things and they think, oh, okay, they're not that meaningful. But when you start, I guess, cutting them down to these are the things you need to do, these are the things you want to do, your money's going a lot more towards needs and a lot less towards want, which plays into the baser human element, the behavioral economics of joy. If you have to pay for things and you got to do these things to survive, you don't get the same joy as buying the thing that you want to buy that you don't have to buy. It's that small hit of dopamine that we get on every single daily basis. And I think that's at a very human element level, part of the reason people don't feel as good working. And I say that because people used to feel tribal. People used to feel like work was part of a tribe they belonged to. And I think work from home in part, certainly, but a lot of what's happening in corporate America is changing that. And as a result of it, you're seeing a lot more migration from one job to another job in a shorter duration of time, which some companies are looking at as a benefit because you've got all this exposure to different companies. But the sad nature is we're losing the tribalism that made working for a company for a prolonged period of time valuable. And that's what kept employees there, that culture. I don't think people care as much about culture as a way of keeping them there if they can't get the inward benefit of making enough money to buy the things they want versus the things they need. And that chart right there is really indicative of it. I'm actually going to take that and put that in the show notes as well. A lot of people will watch this show, the live shows later on in the day. I do recognize it's midday and people are going like, well, what the hell, bro? Like I can't get all this stuff in. Yeah, I understand that. I fully appreciate it. And I think the reason why we do it in the middle of the day is pretty obvious. We want to see what goes on while we're trading throughout the day. And like, for example, on Wednesday when we do the FOMC live, that's part of the reason why we do that. Let's go over here to, let me break this off a little bit. There we go. Let's go down a little bit more here. Nancy Pelosi is all over the news. And this is one of those things that's so shocking to people. I think that it really bothers them. And so it just becomes like this like doom scrolling, like angry rage bait that people click on. Kobisi Letter, huge fan of his page and of what his data that comes out here says. Breaking U.S. data center construction jumped 18.5% year over year in October to 2025 to a record of $42 billion annualized rate. This is $3 billion below the $45 billion spent on office buildings. Interesting. This comes as spending on data centers has tripled since ChatGPT's launch in just November of 2022. Wow. Over the same period, office building construction has declined about 40%. At this rate, data center construction will surpass office building construction levels as early as this year. AI is redefining the U.S. economy. Yeah, and we've talked about how data centers and electrical energy are going to be really the wave of the technological future here. And I think that this is going to be what it is. And I think these trends are pretty indicative. And think about this conceptually from a human perspective, right? We know work from home has been a problem, but we talked a bit about the refinance sector. I'm going to go back to one of our sector charts earlier. This is your commercial real estate, right? Because the vacancy, God, that is I cannot draw arrows to save my life. Let's try this again. There you go. More arrowish. All right. That is the trajectory of commercial real estate spending, building new ones, repurposing old ones. And that is the clear trajectory upward of these data centers. And again, data centers require power. This power and the data centers are all for compute. These power the AI models. So you're really betting on that ecosystem. And this is what I talk about when I say that I think some of the outward, the adjacent to AI space, if that makes any sense, I think these sectors are really poised for growth. And I don't think they're heavily as invested in as much or talked about in the media. By the time you hear about this stuff in the media being where you should invest all your money in a little bit more headline-driven rhetoric, it's probably going to be too late. You're going to lose all of this upward momentum that we're seeing already. So keep that in mind. But let's go back to the chart a little bit that we showed earlier, showing you the sectors, because I think what's important here is that we compare exactly what just happened. So let me go to the sectors, and I'm going to pull up commercial real estate and REITs. Here we go. And there you go. There you have it. So again, these are not outperforming the market, but a lot of these are in what I would call traditional commercial real estate. This is on the downward spend. So one of the things that I will commit to you in the show is we've got to find the companies that are going into commercial real estate in the form of data centers. We've got to find the energy companies that are putting their money there. And we've got to come up with a separate sector chart which shows their performance, because this is the traditional commercial real estate. A lot of these have exposure to office. A lot of them have exposure to retail as well. But they're going down this way as far as overall spending goes. And I think you're seeing some of that stuff. So let's show you an example of what that looks like so that you can kind of compare a little bit. And let's just pick one here. I like Simon Properties, SPG. I've done a lot of work with them and around their people over the years. Smart group, but they're in a space that's really, really struggling. And I will say, in their defense, this typically happens, every several years, where you get the retail sector kind of goes in waves, like traditional recessionary economies, and it might not feel that way, especially if you're a bit younger, because you've had 16 years of artificial interest rate deflation, this amazing prosperous economy that we haven't had for this long ever in American history. And frankly, as a result of that, they're in for some slow, painful times. This is Simon Property Group's stock one-day chart. It's not really telling, right? Lows and highs. They're almost near session highs. So nothing really cataclysmic or concerning here at all. But when you look at them from a one-year perspective, I think we're going to see something very different. Let's generate the chart. There you go. Oh, actually not too bad. So from a one-year perspective, they're pretty good. They're up a meaningful amount. So that goes to show you that the fear of retail at least hasn't hit these guys yet. I've seen a lot more vacancies in my neighborhood as far as retail goes, but if they believe that these guys can make money because the fundamentals are there, then they will. So, and I think that's actually a really telling thing that you can look back on and go, okay, you know what? The market doesn't think these guys have the exposure to the underlying credit losses that we talked about, right? I think that's probably right, because do these guys have the cash to put in on these properties when they refinance them to bring the loan to value down to where it cash flows still and cash flows positive for their investors? And I think the market is telling you via what they're saying in the stock price that is the case. Let's check one more just to make sure that this isn't unique here. Let's go to American Tower. AMT is often talked about. Let's go to that one and see what that looks like, both on the 1 day, and we'll take a look at them on the 1 year chart. I think that'll be interesting telling. Okay, so this one's trading near session lows at the low of the day, but still up incrementally. Let's go out to the 1 year chart here. And okay, so this one's a little bit more impactful, and I would say American Tower, from what I recall, and I'll double check this, I think they have more office space exposure, whereas Simon has more retail exposure, is probably my guess. But the market's telling you here, with them 5% down over year, that they are concerned about the underlying refinance risk. So again, this is a great example of why the refinancing risk in this particular sector can be visible as you look at the stock and the underlying makeup of what's in those companies. Clearly, the market is saying we're more worried about office than we are about retail. And that's how these charts all work together. And that's how we're going to use these charts to forecast what we think are going to happen in the future on other usages at some point in time. I want to I don't mean to be cryptic about that, but what I'm trying to say is that at some point in time, we're going to use these charts to say, okay, we think this is where these stocks may be going in this sector. Not necessarily specific stocks and recommendations, but certainly some trends that we see, and we'll let you guys make informed decisions as a result of that. Let's go a little bit longer on X here. I think the narratives are really interesting whenever the comment section. So grain of salt here. Whenever you get into X in particular, but any platform in general, you've got to discount the comments because a lot of the comments that come up are from bot accounts, which will have a political agenda or a reason to say the things that they say. So I often read the accounts, but if they're not verified accounts on X, I discount them heavily. If they are verified accounts, I want to make sure that it's a verified account with a name that's behind it. Somebody using the real name with a verified account is generally going to have less of a slant politically. So, or I should say that, less of a hidden agenda to their political slant, I should probably say. This is a great example of this. John Brooks asked Charlie Bilello why he thinks that so many people are canceling their transactions. Let's go into this and see what people say, right? I think this is the rhetoric of the show. My take, prices aside, economic uncertainty is really bad for business. I agree, but again, his point there, economic uncertainty is bad for business, but then I go, okay, well, let's look at our synthetic volatility index. There doesn't appear to be economic signs of uncertainty here. There's a human element where we all can think, feel, it's tactile, it's that kind of elevation feeling in your lungs whenever you're running. We all know that it's there. We feel the weight on our chest, but the market doesn't show that. So to his point, I feel it. I get what he's talking about. But if I were to look at the volatility index and the markers that we typically look for, that doesn't necessarily align. And you also have the added challenge of, look, I mean, gold all-time high, stock market all-time high, real estate near all-time highs, although values are on average coming down. Sorry, wherever you are out there, the pundits who are like, real estate values are only going up. Dave Ramsey. Every year for the next 5 years. Well, that did not happen. And frankly, it should not have happened. That wasn't healthy anyway. 70% of Americans are paycheck to paycheck, and another 15% are barely covering. This economy is not producing at 5% GDP in a golden age. BS scraps does not an economy make. That's actually valid. And I wouldn't be so, I guess, loathing in my commentary about it, but we have seen a K-shaped economy. And let's talk a little bit about this K-shaped economy. And I'm gonna draw a little bit of this over here so you can see it. But GDP is 70%. Okay, 70% of consumer spending. I really got to work on my drawing. I know it sucks. Sorry. 70% of consumer spending props up GDP. The rest of it is other things, government spending included. All right, and this can be propped up by a small minority of people spending a whole hell of a lot of money. So think about what you see on social media on a pretty regular basis, right? Everybody's out here rolling in the Raris and the Lamborghinis and all this other stuff, right? So you've got this K-shaped economy. We've long heard about people wiping out the middle class. And that is really what the K-shaped economy is trying to say without saying it. It sounds really dark when you say the middle class has been wiped out. But that's what the K-shaped economy says. You have an upper class and you got everyone else. But I'm going to call it lower class for the purpose of this conversation. And what we're seeing here is the spending by this upper class is carrying GDP up, even though this lower class here is not spending at the breadth that it once did. Certainly since the pandemic to now, where all the stimmies and the extra savings and all that are gone. So I think we got a real problem here on our hands. And one of the things that we're not addressing is how do we get wages up? Because wages coming up, believe it or not, and this is the problem with AI and some of the things we're seeing in unemployment, wages coming up will help solve some of these problems and continue to boost spending and things like that nature. You can't continue this divide in perpetuity. At some point in time, there is an inflection point and there will be some resistance to it. Right now, people are paying way more for necessities and way less for the things they want, like we covered earlier. But at some point in time, that spills over to frustration and anger. And I think that's why you see people like Mondani getting elected in New York, where he's really ran on, and again, this is not a political sentiment, but the things he said were really socialist ideals, because so many people are disenfranchised and feel like they don't believe in capitalism anymore. You go on social media and it's all in your face, it's rubbing in your face, but yet you live in an area where very few people can afford to buy a home. Look up those stats in New York and it's grim. Very few homes actually trade there now because you just got this legacy wealth that doesn't need to sell some of this stuff as well. So it's a very interesting and dynamic economy. One, again, I continue to sound the alarm for that we haven't seen before. It's not to say something cataclysmic is on the horizon, but certainly you've got what I call a strange and pressured time. I'm going to jump on over to Instagram here. I like to check Instagram, the gram. And for those of you going, hey, Chris, like, why don't you check TikTok? Fun little fact. TikTok won't allow me to stream vertical format onto their platform like we do here. If you're watching this on Instagram, you see a top and a bottom here in a vertical format. TikTok allowed us to do it, but they actually don't want well-produced like TV show content going on at TikTok. They want you to be holding your phone. So if you don't shake and rattle enough, or it doesn't look unproduced, if you will, then they won't allow you to stream on their platform. So they took my ability to stream there away. So we're going to look a little bit at Instagram here on the social view for a brief second, and then I'm going to go over to, oh, that's weird. Huh. It's shifted over to the left. Well, that sucks. Oh, Instagram. Let's see if that works. Oh, no. Well, that's not good, is it? Okay, well, we've got another way to do that. There you go. I'll fix the Instagram thing. GME surges after Michael Burry says that he's buying back the stock. And this is kind of one of those things where you see these headlines come up like Yahoo Finance right here, and you go, okay, wait a minute. So Michael Burry, the man who said he wasn't going to manage other people's money now, is now saying he's going to buy it through his family office, and that sends the surge going. This is GameStop, GME. We got to check this, right? I mean, that's just, I got to do it. Let's go over here. Let's check GME and see what that surging looks like. This is not a stock I want to play in because it scares the hell out of me because you got to watch it pretty aggressively. Okay, so it's down this is over the year. Let's check the day. There you go. So, buck up if you're day trading, and I'm not an advocate, but if you day trade and you're a retail trader, you make some money today. So surging is interesting. So let's just go back here. This is the chart for today. $1.24 up, 5.31%, $24, right? Okay. Cool. Let's go over to the screen here. This says 24, 1 point something, up 7%. So we've seen a little bit more of a response with this coming back down since that time. Monitor the headlines. I mean, surging is probably not the right vernacular for what we're seeing here, but I guess if you own a lot of it, great, good for you. And this is what sucks, is like the narrative can drive so much of the behavioral economics behind some of this stuff. New York City is often called in Alaska. That's cute. Nobody cares. Models. Nobody cares. My guy Caleb. What up, Caleb? He works for Logan Paul, Jake Paul, the podcast Impulsive. So pretty good. Club Shay Shay. Yeah, you can tell my Instagram feed is not what it used to be from an economics perspective. Given an unchanged tariff burden, large additional investment cannot be funded, Volkswagen CEO. Interesting. This is Volkswagen may halt U.S. factory plans unless tariffs are reduced. And this is where companies try to threaten back when they're caught up in the middle of larger geopolitical conflict. And that can always be taxing for everybody because this does impact how their supply will be delivered to the market, which may impact demand and obviously sales over time. So I think that's going to be an ongoing trend as we see a lot of this stuff kind of work out and play out over time. God. My Instagram feed is just getting wonkier and wonkier and wonkier. I don't know what the hell. Oh, did you guys ever see this? This is the Guy Fieri thing. Everyone's like, oh, Guy Fieri changes look. I'm pretty sure this is just him using AI to change the way he looks, but that's supposed to be Guy Fieri. But everybody's making a big deal out of it. I don't really understand why. It's kind of weird, right? All right, well, there you go. That's a show, kids. Let's do one more little quick wrap up of everything that we saw today on the charts. Let's see where we're at here. I'm going to refresh some of them so you can see what they look like when I refresh them in real time. Let's go over to the status of the market. Okay, we've now shifted from mixed day into defensive. There you go. And this is what I mean. Let me refresh it again real quick. I like to do this in real time, from time to time. There you go. Okay, so yeah, all right. So we're wavering a little bit. So it's going from defensive to mixed day. So we're right in there. And I would say that's probably a normalized response to what a very kind of flat market is going to be before an FOMC rate cut decision, where they don't expect a rate cut to happen. So I think that's pretty interesting. If anecdotally we thought rates were going to go up and they were going to increase rates, you would see a pretty grim day here, and it'd be all red. And I think you'd probably be closer to the risk-off defensive category. As it stands, we're really kind of like right there in the middle of where these two kind of cross in between, and that's why the chevron there is pointing down the way that it is there. So you're going to see some bouncing back and forth. But again, as we approach about an hour from the close of the markets, again, no clear trends in the market. Synthetic volatility index we've covered. This has actually come down from 90 last week, down subtly to 86. I think we are starting to see a little bit more fear in the markets, but nothing that's going to move you from calm and normal in the tense, at least not now anyway. And then, of course, all eyes again will remain on that rate decision. I will see you all hopefully next week for the next week on Wednesday for the FOMC decision. Again, we're going to start about 30 to 45 minutes before the 11 o'clock announcement. We will be covering other media outlets and their guests. We definitely will be bringing you David Kelly, some of the folks over at CNBC, and some of their commentary. If there's anything you want to see on that show or anything in this show that you want to, get into more, please email us, media@higherstandardpodcast.com. And if not, head on over to Jordan Fridays. Enter the code HIGHER. Get some peptides, GLP-1s, I microdose, the GLP-1s and tirzepatide. And I do some peptides as well. So if you ever want to talk about that, I'm always available. Otherwise, hopefully it was a good show. Hopefully we learned some stuff. And if anybody has any chart ideas, let me know. I'm always open to hearing more about some chart work. Shout out to all you out there. I love you. Bye.
Yeah.